Diversification is a risk management technique that combines a wide variety of investments in a single portfolio. The rationale for this is that a portfolio of different investments will, on average, over time, yield a higher return than a single investment, thereby improving the quality of the investment return. The main reason to diversify is to reduce risk. And risk means different things to different people. For us, it is synonymous with timing. The riskier the asset, the more time you need to be confident in achieving your expected return over time. Timing risk is also, for us, not achieving the desired expected return on withdrawal or drawdown. In order to diversify, we need to look at a client's specific risk budget. Our job as financial planners is to assess a client's risk budget and deliver an investment strategy that will give them the highest return for their tenable amount of risk that they're able to take. However, within this, if we are able to reduce risk, we're able to strive for a higher return. This is where diversification comes in. In order to reduce risk, you combine portfolios by combining asset classes. Each investment strategy has its own risk-return characteristics and profile. And the most important investment strategy for a client is the one that delivers the highest return for their specific risk budget. In modern portfolio theory, we call this the efficient frontier. It is widely accepted that equities deliver a higher return than bonds, which deliver a higher return than cash, but returns which are less dependable in the short term. Within each asset class lie a whole host of other risks, which we are able to look at diversifying away in order to reduce the risk profile of the investment. Within each asset class lie a whole host of other risks that we are able to diversify away. The first being investment manager risk. No single manager performs well all the time. By combining managers with different investment processes and philosophies, we are able to provide a smoother return over time. Another risk within the equity asset class is that of company or stock-specific risk. One needs to invest rather in a portfolio of shares as opposed to an individual stock. And by doing this, you are able to earn an equity-like return, but at a lower level of volatility. The third risk within the equity asset classes is that of sector or industry risk. Often clients will hold a portfolio of shares quite focused in a specific sector due to the fact that they feel more comfortable with the sector as a result of working in it or that they have a specific interest in the sector. It is very important to look through a portfolio, whether it be of shares or mutual funds, to assess the sector exposure and diversify that away. And the last risk, and for me being the most important as a South African investor, is that of geographical or country risk. And we all know the risks that we are facing domestically. Many clients feel that they are appropriately diversified within the equity space by holding a general equity unit trust. However, few know that the South African share market is but 0.98%. That's less than 1% of global market capitalization. By diversifying globally, we are able to move away from our country-specific risk and invest in the other 99% of global market capitalization, and in so doing, also accessing other sectors and companies that might not be available in South Africa.